Ladies and gentlemen, welcome back to the channel. In today's video, we will discuss a little bit more of what happened today in the markets. You are seeing a bit of a recovery here in after hours. Now, I will say Tesla stock itself was only down like 1.35% today. It wasn't a terrible day for Tesla. Now, you're up 0.5% in after hours. There is some news causing the S&P, for an example, to go up 0.2%, specifically related to Google. Now, so you are seeing this little bit of a bounce back, but again, we need to talk about really what to expect in September. Now, we do have some economic data coming out tomorrow that is absolutely critical for markets. And to top all of this off, we do have some Tesla news that I want to share with you in today's video. And finally, there was something very, I don't want to say scary, but something you really need to know that happened today. It has to do with the reverse repo market, and that has implications for the Fed specifically. And this could help explain why global bond yields today went parabolic, like over in Europe, in Japan, in Turkey, and in the US, among pretty much every country, developing or developed country, pretty much everyone had yields that skyrocketed today. And there could be one big reason for that. So hit the like button and subscribe to the channel if you have not done so already. Let's get into today's episode. As always, if you want to come trade with us live in real time, check out the link down below in the description of this video. The one stock that I have over $100,000 personally invested, and now like $120,000 because the stock has went up a little bit, but just scratching the surface in terms of where I think that stock is going. Had some big news today. And I think over the coming days, it's going to get pretty exciting over there. Check it out, link down below in the description of this video. So first and foremost, I want to start with what happened today in markets. So generally, again, I explained this in the last video, but 80% of trading volume every single day is done by computers. The computers have a natural bias during different times of the year, okay? The computers are programmed right now for any small piece of bad news to sell stocks. They're not really programmed to like get aggressive in buying stocks right now. That's what you need to know. Like, we could have the best news ever, but if we have a little bit of bad news, like, nobody's going to care about that good news, okay? Long story short. So there is a heavy bias towards a downside in September. If you are an emotional individual, stocks or not, you probably just shouldn't look at your portfolio in September. Like, if there was a month to just literally take a hiatus and don't look at your phone, don't look at your portfolio, it is September. Now, if you are someone that is able to manage your emotions and no matter what happens in markets, stay kind of stoic, right? Then you could profit immensely from this opportunity, especially if we do get further downside. Now, what happened today was the news that Trump's tariffs potentially are going to be canceled. That is actually leaving the politics out of it. The actual implications of that are very much net positive, okay? What does that mean? If Trump and his tariffs do not go into effect, that means better earnings for companies. That means a stronger economy, presumably translates into better earnings. That means lower inflation and an easier justification to cut rates. What is the negative offset? Higher deficits. Deficits 10 years from now, if they're running at the rate that they are running at, like let's say $3 trillion or $2.5 trillion in a single year, like 10 years from now, that's going to be a big issue. But right now, like, is the government at risk of defaulting via the deficits? No, it's like, yeah, there's a problem that's starting and you should address it, but it's not going to kill you in a year, right? You're going to have another decade or two to ultimately figure it out, okay? So again, if we weren't in September, this would have likely been seen as a really good thing. Now, the biggest kind of negative thing about this is the uncertainty. Now we don't really know, are we going to have a certain tariff rate? Are we not going to? Where should we invest? Okay, things like that. And uncertainty instinctively causes investors to sell stocks. Specifically, again, algorithms that control 80% of the trading volume on any given day. When you introduce uncertainty in September at all, even the slightest bit, it's going to make for aggressive downside. That's just the fact of the matter. I think partially the reason why stocks recovered into the end of the day, at least a little bit, is because like people will start to realize that, oh wait, this is actually not bad news. Okay. So again, today, one of those weird days where stocks just kind of do their own thing and don't trade very logically. Okay, we have to accept that. Now, one thing that happened today in the reverse repo market is actually worth paying a little bit of attention to. Let me give you a little bit of the backstory here. Okay, so the reverse repo has went on for a very long time. Okay, and it started to get dangerously low recently. Okay, even like July 31st, there was $214 billion in the reverse repo. What this is, essentially, to boil it down, is banks, they cannot sit with a bunch of customer deposits. Just simply like inflation, like zero. Okay, let's put it this way. Okay, if you're JP Morgan, you got 50 billion in customer deposits and inflation is 0.025% on any given month, just instinctively right there, you're going to lose $125 million just based on that alone. Okay, like that's a lot of money to lose to inflation. So what happens is excess cash gets parked with the Fed, and the Fed pays a certain interest rate. Okay, you can find it here. The rate is 4.25%, pretty much directly correlated to the federal funds rate. Okay, that's what the federal funds rate is. It's not setting interest rates for, you know, homes and for cars and all of that. It plays a role, but it's really the rate the Fed pays banks to park their money with them. And it's the rate that banks have to charge each other to park money with each other. If JP Morgan's like, hey, Morgan Stanley, you know, I need $1 billion until tomorrow because there's something that is coming up, then they're going to have to pay the federal funds rate to get that money, right? And it's obviously divided. This 4.25% is divided daily. So you're not getting 4.25% for one day, okay? That would be ridiculous. So you get the idea. It protects banks against inflation. Well, as the Fed has been running off their balance sheet, it comes from this excess money because banks can do one of two things with customer deposits, and that's it. They can lend money and they can buy treasuries. That is it. That is all the banks are allowed to do with customer deposits. They cannot go out and buy stocks with customer deposits. They cannot go build a new headquarters with customer deposits. All they can do is lend out money and buy bonds. Okay, buy government bonds, certain risk structures, right? Certain grade, like AAA bonds, right? Okay, maybe they could buy like Apple bonds or something like that, perhaps, okay? But generally speaking, it's treasuries. You get the idea. Well, as this money falls, there's less of a cushion for the Fed as they are running off their balance sheet, okay? You get closer to like running out, okay? Here's what happened back in the day. Type in reverse repo crisis. Okay, I forget what year this was. I was investing in markets, but September 2019. Okay, it says on September 17, 2019, interest rates on overnight repurchase agreements or repos, which are short-term loans between financial institutions, experienced a sudden and unexpected spike. A measure of the interest rate on overnight repos in the United States, the secured overnight financing rate increased from 2.43% on September 16th to 5.25% on September 17th. During the trading day, interest rates reached as high as 10%. Basically, what happened is the money dried up. It was just gone, right? Reverse repos, like there was no money left. it says the activity also affected the interest rates on unsecured loans between financial institutions. So as this reserve falls, it's less of a buffer, okay? It says, and the effective federal funds rate, which serves as a measure for such interest rates, moved above its target range determined by the Federal Reserve. This activity prompted an emergency intervention by the Federal Reserve Bank of New York, which injected $75 billion in liquidity into the repo markets on September 17th and continued to do so every morning for the rest of the week. Okay, on September 19th, the Federal Reserve's Federal Open Market Committee also lowered the interest paid on bank reserves. These actions were ultimately successful in calming the markets, and by September 20th, rates had returned to a stable level. Okay, and it says the Bank of New York continued to regularly provide liquidity to the repo market until June of 2020, and then boom, like liquidity exploded, right? Fed started quantitative easing, blah, blah, blah. What is starting to happen here, because the reverse repo market was only $21 billion today, okay? And it's been on the low side, but this is the lowest it's been since 2021. The Fed almost has to stop quantitative tightening soon. They almost cannot continue that, because if there's not leftover cushion money here, then you may not get banks that show up to auctions as much for bonds. Okay, imagine if the government was trying to sell 50 billion in bonds and banks only showed up with 20 billion or 10 billion or none. Interest rates are going to skyrocket. That's a problem, okay? That is essentially what this is pointing towards. Liquidity is draining. And that could be a reason why, bond yields globally spiked today, because someone's saying, hey, maybe there's something not right happening in the reverse repo market with liquidity wise. Okay, so that's something to watch. It could actually turn into a positive catalyst if the Fed does start low dose like quantitative easing. That could definitely turn into a bit of a positive for this market. Now, tomorrow we are going to get some economic data that's going to be very important. It's going to sway the odds of Fed cuts. Now, as of right now, the probability for Fed cuts. So even though interest rates on bonds or like yields went up today, the odds of Fed cuts also went up, which is not like typically what you'd expect to see. If bond yields go up, you'd expect the probability of rate cuts to fall. In fact, that's not what happened. You went from 88.9% chance of a cut in September to 90.9% chance of a cut. So the odds of cuts went up today. Kind of unusual. For October 29th, you are pricing in now another rate cut, okay? 48.3% odds of, 3 rate cuts? That's what it's looking like. By October 29th, and then December 10th is pricing in 4 rate cuts at a 36.2% chance and 3 rate cuts by a 47.6% chance. So once you get above 50, you're technically going to be pricing in 3 cuts by the end of this year. But the probabilities moved up across the board today for more cuts. Again, bond yields going up, you wouldn't think that is what happened, but that's what happened. And I think it's partially, again, because of the reverse repo conditions that are starting to come about in the markets. Like the Fed almost with a certainty has to stop quantitative tightening here very soon. But again, tomorrow's economic data is going to play into interest rate cut probabilities. So tomorrow, you're going to get JOLTS job openings for July. Now, here's the deal. This data comes from the BLS, Bureau of Labor Statistics. Trump fired the head of the BLS last month because he said basically the numbers were bullshit. Okay, that's what Trump said. Paraphrasing, of course. Well, Trump's going to look pretty stupid if the numbers come in even worse. Okay, so whether you think the numbers are right or not, I think there's a heavy kind of motivation to have some good economic or jobs numbers this week. JOLTS job openings is the start of that BLS data spree that we will get between Wednesday and Friday. So JOLTS job openings, basically how it works is the more job openings, the better. The more positions that need to be filled, the better, okay? Because if the economy was starting to suck and head towards recession, people would not be looking to hire. You are expecting this number to fall from 7.437 million down to 7.4 million, or as low as 7.3 million. Again, that would kind of be a slap in the face from Trump. If we have even worse numbers. Okay, so that's a big one to be watching for. I actually think you might surprise to the upside because of that logic of thinking, right? Trump doesn't want bad numbers. We'll see. Now, for Thursday, Challenger job cuts will be coming out, expecting 89,000 there. Last month, you had 62,000, and the ADP employment change is expected at 68,000. And last month was 104,000. You get exports, imports, the balance of trade, as well as initial jobless claims on Thursday, and ISM services PMIs. That is probably going to be the most important catalyst for the markets on Thursday, but they're all kind of equally important. On Friday, you get your big data, that is non-farm payrolls and the unemployment rate. Again, you don't have high expectations here, and I think Trump doesn't want to look stupid in firing the BLS to get a really bad jobs report again, right? I think there's a heavy incentive to give us some strong numbers, at least for Friday. And that could spur a pretty good day for markets, I'd imagine. Now, in Tesla stock-specific news, Edmunds has rated the new Tesla Model Y the best car they've driven in 2025 after testing more than 200 vehicles. Waymo says they will start testing in Denver in the coming months. They will use a mixed fleet of Jaguar I-Pace with the 5th gen hardware and Zeekr RTs with 6th gen hardware. They say, quote, our next generation system is informed by years of winter weather experience across Michigan, upstate New York, and Sierra Nevada, and engineered to autonomously sustain operations in harsher climates. In final option activity today for Tesla, you had 93 different trades from hedge funds and institutions, totaling $168 million with a positive order value of 23%. So yeah, a pretty rough day as far as option activity from hedge funds and institutions. And you only had about 9,000 shares that were on net covered by these hedge funds and institutions. So yeah, definitely not a great day. And again, I think it has to do with the trading algorithms more than anything. We have to accept September is going to be a bad month. The question that I have is it going to be like a really bad month? Is it going to be just like a burner month where there's a lot of volatility, but we don't move much? I would imagine it's probably going to be like a 4% kind of down month, right? It's not going to take a lot of bad news to get stocks to fall like we've seen today. And you just have to be stoic to it. As long as we don't have anything that is like going to materially change the earnings outlook for next year, we're good. I mean, last earnings, the one that just passed, was like 3 times better than expected. It was the best earnings season we've had in a very long time. Earnings are not going to collapse. Earnings expectations likely get revised higher if tariffs go away, right? Or if a lot of them go away. So even though stocks might react, really bad to certain headlines, it's not all bad. And that's something I really want to hammer home here because it could make the difference in you making a lot of money or losing a lot of money if you let your emotions get the best of you. And personally, I'm not hedging here. I'm really not concerned until we get a larger issue, okay? Until we get something to like really say, oh, wow, that's not good. Like that could be a problem. I'm just not like worried about this at all. That's not financial advice. That's not a recommendation. Obviously, come to your own conclusions, but that's how I'm viewing September. I think October, November, December are going to be very strong months, but September, it's just not going to be strong. And that changes nothing for the thesis on the end of the year rally or the larger rally that I see coming in 2026. And Google is up about 6.5% here in after hours, really driving up or helping to drive up the S&P. Now, a U.S. judge rules in Google search monopoly case, orders info sharing with competitors, but rejects divestiture of Chrome or Android. So that was a big win for Google, and it is having a positive impact on the rest of big tech, right? Apple's up a tenth of 1% in after hours. Microsoft is actually down in after hours because Microsoft could have been one of the companies to actually benefit from that. But largely speaking, we'll see what happens tomorrow, but that is a major, I would say, positive development for the space. And Tesla is up a 0.5% in after hours. As we talked about today, there was a lot of good news that came out. And if today was not like in September, if today had happened 2 weeks ago, Tesla stock would have been up probably 5+%. Like, we might be getting a cyber van or some kind of third row Tesla vehicle. That is huge news. Did Wall Street care? Did Tesla go up on that? No, it didn't sell off as bad as you'd think with the markets so ugly today. So it did hold a little bit better than we would have thought, but that was definitely some big news. And maybe in the coming days, you could get Wall Street that kind of, starts to look at that as the positive news that it is. But hey, maybe not. Like, September is a weird month. Again, just shut off your phone if you're going to be emotional, if you can't handle it. Like, that's my best non-financial advice. So hit that like button and subscribe to the channel if you have not done so already. Ladies and gentlemen, come join the trading community as well if you would like to be a part of the action over there. And well, it's not financial advice, not a recommendation, but we are crushing Wall Street's returns. Like, we are outperforming the S&P by like 10x this year. It's kind of ridiculous. We have our own strategy where we're going out and finding these small cap AI stocks before Wall Street does. So you want to be in on the popular companies first. Like, believe it or not, I bought the Palantir IPO. Obviously didn't hold it long enough, but bought the damn Palantir IPO at $10. Hindsight's 2020. Should have went all in. Should have sold a kidney to buy as much as possible. You get the idea. But we're going to be early, and we're going to be right. My opinion, not a financial advisor. Contact one before making an investment decision. And never listen to anyone on the internet and think you are going to get rich unless you do the work and verify everything that is said. Have a great rest of your evening, and I will see you in the next one.